Let's make it real for the listeners in terms of if they were starting a new business, we'll just imagine that they've figured out how to make a new hot sauce and it's really good and they want some money to be able to take it from their kitchen production to factory style. What are you looking for as a credit officer to determine, yeah, this is a good choice. We should make this decision.
So there's a lot of things that a borrower would want to do, get the financials in order.
And what does that mean?
Just make sure that if it's a startup, that they've got, their personal financial statement accurate, encompassing all their assets, that they filed all their tax returns and those are all up to date, that they've got a business plan where it can evidence to a banker that they understand their business, they understand the risk, they understand how to produce that hot sauce from ingredients to the day that it goes on the shelves for sale. So a lot of thought needs to be put into that, and that's what a banker will expect. I think it's helpful, and I've had conversations with different people that knew I was in banking and had their own business, friends of mine that, they would ask me different things about, well, how does it work on your side? And I think that's important to understand from the standpoint of a borrower, what are we really looking at? And, they call it like the 5 C's of credit. And it comes down to character, capacity.
What does that mean, capacity?
That's basically their ability to make the loan payments, and the capacity for them to carry the debt.
Okay.
The other ones are capital, collateral, and conditions, which is kind of what the industry is doing. And so, you can debate, maybe there's a couple other C's out there, but even if you go to an institution that does like artificial intelligence and does credit scoring and all that kind of stuff, some of those components of those 5 C's will be built into their models. The character part of it is largely measured by a individual's credit score. How they pay their bills. Do they pay on time? Have they applied for a bunch of credit recently? Are they maxed out on all their credit cards? Do they have a bunch of installment debt out there, in relation to their income? So a lot of the models that are built in large institutions and some small institutions take those factors into account. So there's part of me that, from a credit perspective, is you can have all these tools which are fantastic for the industry, but it does come down to some pretty basic stuff on how you, as a banker, go through your underwriting process and what you measure and what you really spend some time on. And like I said, when I talk to people about, what is the bank going to look at? I end up always coming back to like those 5 C's and what, kind of how we would look at it from an underwriting standpoint.
So let's talk about that first C, the character one.
Yeah.
And this actually is a question. It comes from my brother who is very attuned financially and really despises debt. So pays for everything as much as he can in cash. Well, it's great up until he goes to get a mortgage, right? Because if he hasn't been putting money on credit cards and he doesn't have that score, what do you as a banker say to somebody like him that says, like, I go to get I have a multi-million-dollar business I'm running. I own everything I use. And yet I go to get a mortgage and the banks say, your credit score isn't very good because you don't have any credit. What do you think of that?
I've seen it before. Actually, my mother had the same problem.
Okay.
And, it was funny because she was probably, 80 at the time and had never had credit. And all she wanted was a credit card and could not get one. So it happens. I guess if I would see that, there's other ways that we could do. Okay, well then give me a personal financial statement. Show me your credit or your checking account history. Maybe we would get some statements from how they handled, just their basic day-to-day checking account. So there's other ways to do it. It's very rare, though, that you wouldn't have a credit score, So, and sometimes it doesn't tell the whole story, but it's certainly a basis or a factor that can be used because it is available for everybody, and it it does give an indication of how they pay their bills. So there's ways to get around it. You just kind of have to think through kind of what your options are. So
we've kind of talked on the surface and about how loans get made and the Fed, but one of the things that I don't know very much about because I've only seen it in the abstract is what happens when somebody doesn't pay their loan and can't pay their loan.
Well, I mean, if they cannot pay or they won't pay, there's really no choice from a banker perspective. We have to get our money back, and we will. A lot of times, if that happens, there is an element of, is it a borrower that's going to work with you? Is it a borrower that's trying to get out of it and you want to give them a little bit of leash to him or her a little bit of leash to kind of turn their business around? If it gets to the point where it's like it's never going to happen or that they're not willing to do that, we've got to kind of assess where we're at. Will our collateral cover the debt outstanding? If it will, then if the borrower is not willing to sell it, then we're going to have to take legal action, foreclose on that collateral.
So you're saying, when you're talking about collateral, you're saying if they have, let's say, like the hot sauce example, if they have a warehouse that they store all that in and they own the warehouse and the land, they've put that up that if they can't pay their loan, then the bank would get possession of that. Correct. And then be able to sell it or...
Yeah.
Okay.
If we had that as collateral. Now, if we just have the hot sauce as collateral, we might be in a little bit of trouble. But it just depends. But that's part of that underwriting process. If I'm going to take on that risk, do I need more collateral to get me over the risk that we're taking on that new venture? Or do we feel good about this borrower's ability to get outside income or whatever to work out of their issues? So,
have you had to take possession of somebody's property?
For sure. Oh, for sure. Definitely. And it's not a good, you don't want to do it, but we still work for a business that's owned by shareholders, and our job is to get our money back. And so definitely, I mean, we've foreclosed on, over the years, we've foreclosed on all kinds of property. We've taken back.
What's the most unusual thing you've gotten back or gotten as collateral?
So probably we got back a motorcycle shop. So that one was a little tough because we had motorcycles and then accessories and clothing. So that one was a little bit different.
And kind of a niche market and probably one that you're not an expert in.
Yeah, exactly. So that one was a little tougher. Sometimes you'd get back properties that were in terrible shape, so that presents challenges, because you've got to figure out, okay, who's your buyer for this stuff? We're not in the real estate business. We take it back and then we want to get it out. So, the good thing about banking is, you work with so many different businesses and so many different customers that there's always, all kinds of stuff. It's not always going to be real estate. It may be a piece of equipment. It may be a vehicle. Who knows? It could be, a unique kind of vase or whatever. I've heard of that happening as well. You lend on a collectible item. It's nothing you want to do, but sometimes it happens. We never took back a vase, but it was just different things. So.
Thanks for watching this podcast short. You can find the rest of the interview on my channel. If you like this video, I hope you'll hit the like button and consider subscribing. I release a new interview with an interesting person every Wednesday morning.